Good evening, everybody. Please confirm that you can hear me. Okay, makes sense. Good that you can hear me. Last class, we started to look at IAS 16, right? Uh, we started to look at IAS 16, and it was a good ride for us in the last class. So today, we just need to look at some illustrations. Yeah. If you have a question, please use the chat room. The chat room will help us use it. So, but I will allow at some interval after my first illustration, I will allow some questions. Right, I will allow you to. I will allow you to do the class. Right, I mean, I will allow you to ask your questions. But for now, let's just listen up and participate in the class. I just want to make sure I'm able to cover up a lot of stuff this night. I hope that's fine with you. Yeah, if it's fine, just comment it is fine so that we can move on. In as much as I don't want noise, at the same time I would want interactions. Yeah, okay. All right, any moment from now, you will see my screen. Can you see my screen? Can you see my screen? Oh, please let's cooperate. Yeah, thank God you can see my screen. So please let's cooperate out or mute your mic so that somebody can read for me. I just need one person to speak. I'm not able to appoint co-host here. Unfortunately, I think it's that other plan. That's where I can make a co-host, but I'm not able to make a co-host here. All right. So sorry, I'll omit some. I'll omit you so that you can speak. But can you hear me still? Can you hear me? Okay. So we want to look at this question. Okay. Why is this thing hanging now? More. Looking like I'll have to read myself tonight. Okay. So let's start. Question 3. I want to believe it's November 2019. What year is this? The November 2019, question 3. So for a level, I will believe, or I want to believe that the examiner will not be testing one question, right? Will not be testing one question, like one standard per question. So you have a lot of standard mixed together. That's where we have to cover of standards for us to be able to gain grounds. So that's why we have to cover a lot of standards for us to be able to gain a lot of grounds, right? So having said that, let's look at this question, for instance. We were told that third refi, that's the question we are solving, November 2019, question 3. So if you see any question, what you should first do is to read the requirement. So the requirement 1 is saying compute earnings per share. If you've not done that, we'll do that in the next couple of weeks. Requirement 2 is saying determine the depreciation expense the directors need to recognize at the year end. So that is relating to, so I'll say computation of depreciation expense. All right. I wish I'm not the one reading this thing, to be honest. Okay, good. So a volunteer can please unmute and then read. Just one person.
Charge reply PLC.
Please, I can't see your screen.
I can't see your
Please log
screen,
out.
sir.
Please log out and try to log in again. I think my screen is visible. Is that?
We can
Can
see
you
the
see?
screen.
You can see it.
You can see my screen, right?
Yes, sir.
Yes, sir.
Yeah. So if you cannot see it, please
Yes,
try
sir.
to log out and then log in again. All right. Please go ahead.
Tedrify PLC is a large publicly listed retail company based in Nigeria. In order to raise some financing for several projects, the company makes a right issue for 1 for 4 on 1st August 2018 at a price of 75 naira.
You
The
can
company's
skip. You
current
can skip the first paragraph. That's speaking to earnings per share. So we've not done that. So you can just move to the second paragraph.
Tedrify has recently received shipments of factory equipment for its new state-of-the-art factory. The factory equipment, which has two significant components, an engine and the body structure, which cost 100 million. The engine requires replacement every 10 years, and the company's directors determine this to be its useful economic life. The structure does not require replacement, but will be retired at the end of its life, which is expected to be 20 years. The director determined that the engine is worth 35% of the value of the factory equipment. The directors are preparing a fixed asset summary at year end and would like to determine the depreciation expense to be recognized in profit or loss at year end in relation to this equipment.
All right. So I think that's the only part speaking to PPE there. And what the examiner wants us to do basically is depreciation. But again, there's one little thing I want you to note at this level. The examiner does not know what is on your mind, right? The examiner is not a mind reader. He wants to know how much you're able to express yourself. So you have to do some extras, because some extras will give you some marks, even though the examiner is not asking. I'm not talking about only this. It spans, what I'm saying spans across all the topics at your level, right? So you have to keep doing some extras to ensure that you get the full mark for the course. So I mean, for each question that is stated in your question, basically. So having said that, now don't forget that in the last class we looked at PPE, and we said PPE has to do with owner occupied property used for the purpose of business, right? And one of the things we spoke about was the idea of depreciation. And I remember also in that class that we spoke to complex assets. And we said complex assets are those kind of assets that have different components, right? And because they do have different components, right, then each of the different components can be separated, or can be separated, meaning separation in the sense that they have different useful life, but all the components will be brought together to form a single asset. So that kind of asset is called a complex asset. And if you look at these assets that we are talking about here, the examiner is speaking to us about, are we together, please? Eh?
Yes, sir.
Am I alone? Okay. So the examiner is speaking to us about one thing: terrify as a safe treatment of factory for its new state of the art. The factory has two significant components, right? So we have two components. We have the engine, right, is one component, right? And then we have the body structure. Does it make sense? Right.
Yes, sir.
So the engine requires replacement every 10 years. So it means that the useful life of the engine is how many years? It's 10 years. Is that correct?
Yes, sir.
10 years.
Right. Now, if the engine requires improvements every 10 years, and the company's directors determine this to be its useful life, invariably, I mean, the structure does not require any replacement, but it should be charged at the end of the life, which is expected to be 20 years. So the useful life of the body structure is how many years?
20 years.
20 years.
Yes.
So good. We are picking our point. So that makes it complex, right? Because two assets will form a single asset, but they can be decomposed as a single asset. That means they can be depreciated individually. The directors determine the engine is worth 35% of the value of the factory equipment. So what is the value of factory equipment? Is 100 million. So what is the value of engine?
35 million.
35% of 100 million, Abi? And that's 35 million. And if two assets will make 100 and one is 35, it means value of the body is what? 65.
65.
Correct. Are we together? The directors are preparing a fixed asset summary at the end of the year, and I would like to determine revision expenses to be recognized in the POL for each asset. You can imagine, and they give this thing sale mark, very simple. So invariably, depreciation for factory equipment would be don't want to disturb me. Engine. If the examiner is silent, you will always assume straight line, right? You will always assume what?
Straight line.
Right. So engine will be good. Engine is 35 million divided by 10. And that gives you what? 3.5. While the body is what? 65. Abby? Divided by 20. And what does that give you?
3.25.
3.25 million. Does that make sense to you?
Yes.
Total depreciation. What? That's how much? That's 6.25 million. No, it's 6.75, Abby.
6.75.
Yeah, 6.75 million. So if you do it this way, you will not get the sale mark, I believe. Because that's, but although if you do it this way, you've answered the question basically. But again, if I were you, I would do some extra to show my skill. I would do accounting entry. Accounting entry. And what is the accounting entry? You debit your P&L, right? That's your depreciation. How much? 6.75 million. And then you credit accum dip, which technically is a reduction in the value of the asset, right? 6.75 million. And that's the end of a 7-mark question. Very simple. No thinking required. Any question? Do you all understand? Hello?
Yes, sir.
Yes.
Yes, sir.
Okay,
Yes, sir.
good. Is a past question, no? Okay. All right, let me look at another question that I can quickly deal with before I move to the next topic. All right. So just a minute. So, uh, sorry, just a minute, please. So let me do November 2015, question 4. I think after the second question, I'll move straight to the topic of today. So, So November 2015, question 3. Let's go ahead.
Can we read, sir?
Yeah, please go ahead.
Mimico leased its head office during the current accounting period, and the agreement terminates in 6 years' time. There's a clause in the operating lease related to the internal condition of the property at the termination of the lease. The clause states that the internal condition of the property should be identical to that at the outset of the lease. Mimico has improved the building by adding another floor to part of the building during the current accounting period. There is also a clause which enables the landlord to recharge Mimico for costs relating to the general disrepair of the building at the end of the lease. In addition, the landlord can recharge any cost of repairing the roof immediately. The landlord intends to replace part of the roof of the building during the current period. Required. Discuss how items B and C should be dealt with in the financial statements of Mimico.
Sorry, this has to do with lease. This has to do with lease. I will explain it better when I'm doing lease. But the idea is a mix up. But this has to do with lease. This has to do with lease. So I will explain it when I'm dealing with operating lease under IFRS 16. Sorry about that. I'm looking for, there's this particular question I'm looking for. Sorry. May 2015. Is this May 2015? Oh, sorry. Question 7. Sorry. All right. So this is what I was looking for. May 2015, question 7. Please go ahead.
Ondo Telecoms Limited is one of the highest telecom companies in Abuja. 1 month after the year end, the chief executive officer, while reviewing the company's activities, came up with the following issues for the year ended 30th September 2014. The board of directors is not impressed with the performance of the home broadband operating segment, which posted
So
a loss of 1.7 billion in
this
2014.
the first one has to do with operating segment. That's IFRS 8. We'll discuss that later. Let's go to B. I think that's go to B.
The carrying amount of the assets in the segment is 4.3 billion as at 30th September 2014 and 4.5 billion as at 30th September 2013. Professional valuers were engaged and they came up with the fair value of 4.2 billion as at 30th September 2013. The board of directors made the final decision in June 2014 to sell off the assets in this segment and concentrate on other business lines. Since the beginning of
Go ahead. So that's IFRS 5, asset for sale and discontinued operation. Let's move on.
Since the beginning of September, 4 serious bidders have been negotiating with Ondo. The board anticipates the sale to be concluded by end of May 2015 with the transaction cost of 0.3 million.
It's still IFRS 5. We'll deal with it later. But let's go. I think D will address what I was looking for. Let's go.
On 1st November 2013, Ondo Telecoms Limited acquired a block of flats with an estimated useful life of 50 years at a total cost of 225 million. The blocks of flats are to be rented out to its employees and engineers at market prices. The decision to acquire the block of flats was made by the board due to the need to have the engineers close to the head office to attend to technical issues immediately they arise. Professional valuers were engaged to value the flats as at 30th September 2014, and a fair value of 232 million was determined. International Telecom Limited, which acquired Edo Communications Limited during the year, has just published its results. Edo Communications Limited was a direct competitor to
Okay.
Ondo Telecom.
So what we need to work with, I think, is just D and E. So that's the one relating to IAS 16. So let's work with that information. What is the examiner asking us to do? Advice.
Computation. How the above transactions should be accounted for in the financial statements of Ondo Telecoms Limited under IFRS for the year ended 30th September 2014.
Good. So what we are dealing with now is just information D and E. F is talking about customer list, and that should be under intangible assets. Right? Yeah, that should be under intangible assets. So let's just move straight to the points there. So now the first thing, because this is actually a broad question that the examiner said, because he just wants you to pour out your mind about what do you know about a particular standard. So the first thing we need to establish here is which standard guides this point that the examiner is raising. That's the first thing we need to establish here. Right? Don't forget that there are two similar standards but conflicting. Right? Two similar but conflicting standards. That's IAS 40 and IAS 16. Right? Now, the point here is that Ondo Telecoms acquired a block of flats with an estimated useful life of 50 years at a cost of 225 million. So let me say, is this May 2015, Abi? Question what? Let me just see question 3B.
No.
It's November, yes.
Is it November?
Question
May.
7B.
May 7B, thank you.
7B.
7B. All right. Now, if you look at it on the face of it, right, the block of flats are to be rented out to its employees and engineers at market prices. Don't forget, we said that investment, IAS 16 property, plant, and equipment are owner-occupied properties. And if you look at IAS 40's definition, investment property, he's saying that they are assets, that's land, building, part of a land, part of a building or both, held for capital appreciation or rental income. Now, having defined those two things, you may be tempted to classify this as an investment property. However, it is not an investment property because it is rented out to its employees and engineers. So the first point you want to raise is that the asset or the building, the block of flats, is expected to be recognized at what? To be recognized under IAS 16 since they are occupied by the employees. That's the first thing we want to, that's the first point we need to make. Are we together, please?
Yes, sir.
Yes.
That's the first point. All right. Now, having made that point, what is the cost of the assets? 2 to 5 million, Abi.
225.
Yes, sir.
What's the date of acquisition of the assets? 1/11.
November
2013. Now, the blocks are to be rented out to the decision to acquire the block of flats were made by the board due to the need to have engineers close to head office to attend to technical issues immediately they arise. Now, are we following the storyline?
Yes.
Professional valuers were then engaged when? Date of engagement of professional valuers.
30th of September 2014. September 2014.
Yeah, 30/9/2014. And fair value, don't forget we have defined fair value to be an amount at which an asset can be transferred between a knowledgeable willing party in an arm's length transaction, right? That's what we defined as fair value. That is the amount at which an asset, right, can be transferred between two people who do not know each other in an arm's length transaction, right? So now the next thing you want to check is if at initial recognition, don't forget, initial recognition is what? What model do we use at initial recognition? You should always use what? Cost model.
Cost.
And if you are going to be adopting cost model, it means, don't forget, your cost model is cost less accumulated depreciation, less impairment loss, if any. Does it make sense? So it means that under the cost model, so we have depreciation will be equal to, we have 225 million, right, times how many months do we have between what's the estimated useful life? Beg your pardon.
50 years. 50 years.
Times how many months do we have between November and September?
9 months.
11 months.
11.
Times 11/12. Does it make sense? So that's the depreciation figure there. How much is that? Figure me, please. Press it gently. Help me.
20.625.
What's it?
20.625.
20.625.
Yes, sir.
No, that's not correct.
4.125.
4,125,000.
Okay. So carrying amount would then be the cost, which is 232. All figures are denoted million.
Less depreciation.
4. What do you
Sir, is the cost not 225?
It's 225, sir.
225.
Sorry.
It's not.
225 million.
My stepmother came in. Sorry. Okay, let's go ahead. So what do you have as the carrying amount?
22,875,000.
22.875. That's the carrying amount, right? Don't forget that at this point, what we did, let me do the accounting entry so that we don't mess it up. Accounting entry would have been that you debit PPE, credits either bank or payables, depending on the model, with the cost of acquisition, Abi. Are you with me? Of the asset.
Yes.
That would have been the first entry. So the
Sorry,
second
the
entry,
current amount should be 229,125.
It's supposed to be 221.875.
221.875. Okay. Thank you. With the cost of the asset, right? Then the next thing will then be that you debit P&L.
I don't know how you
Hello,
got
sir.
to
It's
depreciation.
220.875.
It is 220, sir.
It's
220.875.
225. 875. Yes, that's correct.
Okay, thank you. Thank you. Thank you. So
Sir,
debit
please, I don't
P&L.
know how you got your depreciation, please.
Okay. So the depreciation is going to be, don't forget that we said that if the examiner is silent, you should always use straight line. Abi?
Yes.
Here now, the examiner did not tell us the model to use, so we'll assume straight line method, right? Because he didn't tell us what to use. So it's not bad if we assume ourselves. So what's the estimated useful life?
50 years, sir.
So we have the cost divided by 50 years. But you don't forget that from November to September does not make 1 year. So you can't just go ahead. So you have to pick up, you have to prorate it and take only November to September from what we are doing. That's how we got 11/12. So one thing you want to be mindful of when you're dealing with IAS 16, IAS 36, IFRS 5 is the date. The date is a bait used by the examiner and it can do and undo. Do you understand? So you want to be mindful of the date. And then you credit Akumdi Babi. And don't forget, we said that that is technically the PPE because the work of the accumulated depreciation is to reduce the value of your PPE, Abi. Is that correct?
And let it be there.
With 4.125.
With the depreciation recognized. So here you are doing 225 million. And then you are doing how much?
4.125.
4.125 million. So that's there. So if you're able to do this, then the next thing we then do is to now come back to the point of evaluation. And at evaluation, the examiners, or not even the examiner, the standard says, once you evaluate an asset, what do you use? Evaluation model, right? And the evaluation model simply means that you recognize the value at fair value. You recognize the asset at fair value. So asset is recognized at fair value. Abi? At fair value less depreciation, subsequent depreciation. I think it's important I put the word subsequent depreciation and impairment loss, if any. So if that's the case, what do we do then? What we do then will be that you debit. I said debit. At this point, the value of the asset is 232 million, Abi. Are we together? Value. The fair value of the asset is 232 million.
Yes, 232.
Yes.
So the next thing we want to do is now to determine the fair value gain or the valuation surplus, which is going to be the fair value less cost to sell. But this time we do not have fair value, so we do not have the cost to sell, beg your pardon. So what's the fair value here?
232.
What's the carrying amount?
225.
No, the carrying amount is 220.875, Abi?
Yes.
So what do you have as the revaluation surplus?
11.125.
11.125. 125. If it were to be under IAS 40, the same thing, but we would have called this one fair value gain. Actually, we are saying the same thing, just that this nomenclature. Some terms are not accepted under IAS 16 and IAS 41. Actually, all right.
So
do you
if
understand?
Valuation surplus in investment property, it will be wrong.
Yeah, it is wrong.
Wow.
We typically call it we typically would call it what's the name? Fair value gain. Yeah, fair value gain. Yes, it's just lingua. It's just lingua. They mean the same thing technically. You get?
Yes.
But just that this standard would not permit it, while the other would permit it. All right. Do you have any question?
Sir, can we still get the solution?
Hello, sir.
Hello, sir. How can we get the solution, sir?
Solution.
It's like the network has knocked them out too. I'm not sure it's hearing us.
We can't hear you, sir.
Sorry, I was logged out.
Get us now.
Yeah, and I had to wait patiently. So our network logged somebody out. I just quickly came in, as it should be. So, do you have any question on what we've done so far before we move to the topic of the day?
We can't see the screen.
You can't see your screen.
Okay.
Sir, please, you didn't send the notes to group 4 for IAS 16.
Oh, is that same for all the other groups?
Yes.
Yes.
For group
Yes.
1 as well.
Okay.
We even group 1, we have not seen it.
Don't worry, I'll send it today. So you have a compiled note today. Sorry about that.
Thank you, sir.
And if possible, the YouTube link, sir.
Just click on the link for the class. Basically, it takes you to this thing. Do you get what I'm saying?
Okay, I mean after class. This one will not link us because
No, I'm saying just that same link I post takes you there automatically. Do you understand?
Okay.
Yeah.
All right.
So do you all understand IAS 16 now? Although it's a baby standard, really. So it doesn't have
Yes,
yeah. It doesn't
Hello,
have
sir.
like yeah. Please go ahead.
Okay, sir. So I want to ask the fair value gain, like the recognition part. You didn't help us to add it. Like,
okay,
we didn't add that
so now
to cost of asset.
Okay. What you do is the fair value gain, you debit PPE. That's the shortcut to it actually. And then you credit revaluation surplus, which is an equity part, right? You credit your equity valuation surplus with the fair value gain on the asset. But that's a shortcut of attempting it anyway. There's a school of thought that said the best way to attempt it is to, but let me illustrate that. The
Hello,
school of
sir.
thought, yeah.
Hello, sir. I have a question.
Yeah, please go ahead.
Hello.
Yes, please go ahead. Or wait, let me hold on a bit. Let me conclude on what I'm explaining here before you go ahead. There's a school of thought that said that the best way to do it is to first debit revaluation account.
Hello, sir.
Wait, hold on. I will attend to you.
Hello.
Let him finish, please.
Debit revaluation account, credit PPE with the carrying amount of the assets. That's what one school of thought is saying, which I think is good, is good, but it's longer. With the carrying amount of the assets. So that way you are removing everything from the pool of assets. Then after that, you now debit your PPE, right, with the fair value of the assets. Then you credit revaluation account with the fair value of the asset, right? Then the third entry will now be that you now debit revaluation account and then credit revaluation surplus with the balancing figure. So if you use this method, you don't really need to compute anything because the balancing figure automatically is the fair value gain. So whichever one works for you, but you know this method we adopted here, right? This first one I gave you does not, I mean, it is a shortcut to 1 and 2. It's practically just looking at the third part basically. Anyway, does it make sense to you? Do you understand what I'm trying to explain?
Hello, sir. Why not put or so that people will not get confused when watching the video? Like maybe.
Okay, that makes sense. So whichever one work, yes.
Okay. And this other method you use, sir, is it that it's like it's more like we removing like declassifying the carrying amount,
exactly. You are first declassifying it, right? You are derecognizing it. I think that's the word. You are derecognizing the assets, right? Then you are now reintroducing the asset again on the assumption that you want to use the difference between the carrying amount and the new value or the fair value now to determine the revaluation surplus.
Okay, sir.
Do you understand?
Yes, sir.
Yeah. But the shortcut is step 1, but the longer route to it, which will give you the same thing, is step 2. But step 2 is the second one, which is the alternative, is more detailed compared to the first one. All right.
But if we are declassifying, like we are recognizing, since we are recognizing and we are using this one with debit PP with fair value, so I think, do we still need to do for revaluation gain since the
no? So you don't. So what will happen is that you will not pass the revaluation gain through PPE again, because the new value has already incorporated both the carrying amount and the fair value. Do you understand? Do you get the entry I'm trying to? Do you get the entry now?
No, like this one now, you said debit PP with the fair value of the asset. So if we are debiting with 232 million, that means it has started the new asset. So do we still need for, is there still need for revaluation gain since the new classification has covered the revaluation gain?
So let me explain with this question so that it will make more sense to you, right? So the carrying amount of the assets is 232 million, Abi. Or what's the carrying amount of this asset? 220, Abi.
Yeah.
Of the assets is 220.875, I think. Okay, good. So don't forget that this asset originally it is a debit balance. So your asset has a debit balance, right? So what we are doing now is when we debit PPE, when we debit your evaluation account now with 220.875, right? And then you credit PPE with 220.875. What that is saying is that we no longer have PPE, right? That's a simple meaning because we've recognized the asset. The asset originally had a debit balance. So putting a credit entry simply means the asset no longer exists, right? Then now what we are now doing again is now we are debiting PPE, right? With how much? 232 million. And we are crediting evaluation with 232 million. Meaning that the new value of the asset is now 232 million. So the difference between this one, which is the first revaluation that we debited, and the second revaluation that we credited, is the revaluation gain. So the idea is that you don't have to pass the revaluation gain through the PPE account. Do you understand? So meaning that what will happen now is that the difference now, you debit revaluation account. So revaluation account is playing a role of what your disposal account will typically play. It's a temporary account. So what's the difference between the two now? That's 11.125, and then credit revaluation surplus, which is now the equity part of it, with 11.125. Doesn't make sense. Hello?
Yeah, yes, sir. It makes, sir.
Do you understand what I'm trying to? Do you understand my point?
Yeah, I understand your point, but it got confused that where you debited PPE with 232, since it should be showing the maybe cost or the cost amount.
No. Oh, okay. So we are two models: the cost model or the evaluation model. The cost model is saying that you should recognize that in historical cost. Upon evaluation, it means you are no longer following the cost model. So it doesn't make any meaning recognizing at historical cost when ideally you are using a valued amount. Does it make sense to you?
Oh, okay, sir. Okay, sir.
All right.
Thank you very much, sir.
You're welcome. Any other question before we move on? So those are typically it under your IAS 16. Any question, please? We good? All right, so let's move straight to, I think I've been able to illustrate this better. By the time we start doing other standards, we may make recourse to them. Let me deal with IAS 36 today. All right. So like the usual practice, I will only explain today. Possibly in the next class, we will move on with the illustration. So what is impairment loss? That's the first thing you would want to ask, right? I have come up to say that impairment loss, right, is the sudden reduction in the value of an asset, right? So don't forget that while depreciation is a systematic reduction in the value of the asset, your impairment loss is not systematic. It's just a sudden reduction in the value of an asset. Does it make sense to you? So we'll say that
Yes.
impairment loss occurs when the carrying amount exceeds the recoverable amount of an asset. Right? Carrying amount, we said impairment loss occurs when the carrying amount of the asset exceeds recoverable amount of the asset. But don't forget that this standard, right, does not cover for impairment of financial assets, right? It does not cover for impairment of financial assets. Impairment of financial assets is covered under IFRS 9, right? So what we're looking at here is basically impairment of tangible and intangible asset, non-current asset, not financial and monetary assets, right? So now I've said something here that looks a little bit funny or big a bit, yeah. So what's recoverable amount? That's the next thing we want to ask ourselves. What's recoverable amount, right? This is the higher of fair value less cost to sell and the value in use of the asset of an asset. So again, we have to decompose this thing again and say what is fair value, right? So fair value, we said, we've explained it before, is the amount at which an asset can be transferred. Are we together?
Yes.
Between
Yes, sir. We are with you.
people, willing parties in an that is not related parties arm's length, basically. Now, if I want to transact with Folashade, are you on the call?
Yes, I am.
No. So if I want to transact with Bashir, for instance,
You can't see your screen, sir. You can't see your screen, sir.
right? And both
I'm
of
on
us
the
know
call.
each other before. Can you hear me?
Yes, we can.
Yes, we can hear
Yes,
you.
sir.
Let
Yes,
us play.
sir.
All right, good. And of us don't know each other before, then you say that is an arm's length. He doesn't know if it's for free or I'm collecting money. But this guy that teach every night, it looks like he will have money, right? And they don't know that book is not money. But let's assume. So that's that sentiment that is driving the pricing, right? Then makes it not an arm's length. So arm's length transaction is that transaction that is conducted on an assumption that both of us do not know each other from Adam. Does it make sense?
Yes.
Right. What is
Yes,
value
sir.
use? Value use, this is the present value of future cash flow. Present value of future cash flow that will be generated from the use of an asset. Right. So let's say, for instance, I have a Kurokwe. Do you know Kurokwe?
Yes.
Okay. Lagos people will know Kurokwe. But in Ibadan, is Mikra, they know. Okpo,
We can see your screen again.
do you have Ibadan people on the call? Anybody from Ibadan here?
Yes, sir.
We can see your
So let's say you have a vehicle, for instance, right? So the amount at which you would generate from the use of that vehicle is the value you derive from the vehicle, right? But now when we have to discount it because of the time value of money, or because of time value of money, we have to discount it. So discounting it now, we now say you have that discounted amount, that discounted value is called value in use. Does it make sense to you?
Yes, it does.
No, sir.
All right. Yes. So again, let me explain. So let's say you have a vehicle. Let's say you have a vehicle, for instance, the vehicle will generate 200,000. You estimate that the vehicle will generate 200,000 annually. Remember that 200,000 last year is not the same as 200,000 this year. Right? In 2020, in 2018, 2019, I remember that in my area, they sell block for, let's use cement as an example. They sell cement for as low as 3,500, 4,000. Right now, cement is about 12,000 naira or 11,000 naira. So that is speaking to time value of money. If we are generating 200,000 annually, that 200,000 for 5 years is expected to generate 1 million naira in total, right? But if 1 million naira is the actual value, you have to discount the 1 million naira to its present value, right? So the present value of that future cash flows that will be generated from the use of the asset is what we refer to as value in use. Does it make sense now?
Yes.
Yes, sir.
Okay, good. While the fair value is the amount you would have sold it if you are selling it now. Does it make sense? So the recoverable amount is the difference between the two. The recoverable amount is the difference between the two. Now, having said that, what are the indicators of impairment? You are going to teach me this one anyway. Indicators of impairments. So the standard says that there are two types of indicators. We have external indicators and internal indicators. So external indicators are the one that are beyond the control of the management, right? That are beyond the purview of the management, while internal is the one that is within the purview of the management. So let's look at some of the indicators of impairment that are external in nature. Who wants to give me an example?
We have the economic condition, which is inflation.
The economic condition is very important.
Inflation.
There is reduction in market value of the asset.
Reduction in the value of the assets. But that's what impairment loss is basically. So you are using that. I don't want to agree with that.
Another external is changes in technology.
Yeah, change in technology. That's a very good one. And I have a very good example. Your example is BlackBerry. I remember when I wanted to buy my boat, was it boat 5? What do you use to call it again? I suffered there, saved money to buy boat, and now the value of that phone is zero. It's inside the house. I can't do anything with it. If I had known, I wouldn't have suffered like that. In fact, at some point too, iPhone 6s, iPhone 7 were 18, I think 2018, 17, but now you can't use them again. If you are bringing your iPhone 7 out, people will just be laughing at you because we've moved past that.
Àgbọ̀ nǹkan kan mọ́ o.
We can hear you, sir.
I can't say anything. Am I the only one? Sorry.
We can't see
Hello?
any. The network is bad from his side.
I think he has been locked out.
His network. Let us give you some time to reconnect again.
Kabiru, can you mute?
Hello, can you hear me?
Yes, sir.
We can hear you now.
So it was the network. So we were talking about changing fashion and taste. So we are saying volatility in FX prices. So if your value of dollar drops, automatically your value. So say for instance, $1 is now equal to 200 naira now, and you bought your car last year or early this year. You know, I'll be happy. I'll be happy. Oh. Yes or no? If $1 should be 20 naira now, I'll be the happiest person on earth. Given that my income remain constant. Abi? Am I alone?
No, sir.
No, you are not.
All right.
No,
So
we are here.
so let's go with the internet indicators.
We can't view your screen. We can't view your screen.
It is your network, sir.
We can see us.
What are the internet indicators? Please, let's go ahead.
Damages of assets.
Damage. The assets.
Fire outbreak.
Obsolescence of assets.
Damage in the assets.
When the resulted production does not meet the forecast figure.
Okay.
Obsolescence of assets.
Decline a production capacity.
Decision to discontinue operation or use of the assets.
Yeah, that does not really reduce the value. Discontinuing operation does not reduce the value of the asset. Can still
Obsolescence. Obsolescence of the asset.
Obsolescence. It could either be internal or external anyway. Yeah, so those are examples of indicators, but by and large,
Yes, sir, can we include where and sir?
Lots of key management staff.
Loss of key management staff does not affect an asset. Does it affect an asset? No.
Sir, wear and tear, does it affect?
Yes, that's the so you want me to put as a point? Yeah, that works. Wear and tear as a result of usage.
So, sir, can we use the same indicator for external and internal? You wrote obsolescence in external and internal too.
Yeah, depending on how you're able to explain it. Unguided usage. All right, so let's go ahead. That's
What's the
fine.
explanation of obsolescence for external?
So obsolescence simply means generally on the face of it is old. So people just do not like it because it's old. An example is your B2, your B2 car. Do you understand? B2 car is an old model, is an old model car. So that's an obsolescence.
Okay,
And
sir.
yeah. So now
Sorry, sir, I have a question.
please go ahead.
Okay, so I just want to be clear. For the external indicators, can we say most of those external indicators will majorly affect recovery amount, while internal indicator will majorly affect the carrying amount?
No, I think no. I'm not sure I got your question, but the answer is still no. Well, I think your question is saying that can we say the external indicators is affecting the carrying amount, while internal indicators is affecting the recoverable amount? Is that what you asked?
Yes.
No. That's not true. The idea there is that at every point in time, the reason for even testing for impairment is because we have a feeling that the amount we're recognizing this asset is lower or is higher than the amount it should be generally. Do you understand?
Yes, sir.
Okay, so that's the idea. So it is both internal and external indicators affect the carrying amount of the asset because we feel there should be a sudden reduction we feel there is a sudden reduction in the value of the asset and we are overstating the asset. Does it make sense?
Oh, yes, it does now. Thank you.
All right.
Good evening, sir.
Yeah, good evening, Chief.
Okay, sir, I want to put in something. When somebody say wear and tear is as a result of overused after a long time. And
yes,
when you use an asset over a long time, you expect that depreciation will set in. So if depreciation sets in, your carrying amount will be reduced because accumulated depreciation will be deducted from your costs. So wear and tear should not make up that internal part of the effect of an asset.
There are usage and there are usage. There are wear and tears and there are wear and tears. If a police officer sorry, do you have any police officer on this call?
Sir, your no. Continue, sir.
But the police officer should use a vehicle. You know that all you are recognizing that vehicle is not depreciation. It's impairment, because what will happen is impairment loss, not depreciation. I understand that wear and tear as a result of usage, but there's some wear and tear as a result of indiscriminate usage, right? Do you understand? You just use everywhere.
Sorry, sir.
Do you get my point?
Sir, I get your point, but that would be a physical damage. That is why the damage is physical. That one is different from a wear and tear. A wear and tear is as a result of usage. Why physical
I
damage?
agree with you that wear and tear is as a result of usage, right? But now you could some vehicles, for instance, with some vehicles look very good on the outside. There's no physical damage on the vehicle, but again, the engine is worn out because of indiscriminate usage. Do you get what I'm saying? So in that case, it is not very fair to say that every wear and tear has accounted for depreciation, because we have some wear and tear that is because as a result of just unguided indiscriminate usage, unguided usage, and all that. That's my point. Does it make sense?
Noted, sir.
Yeah. All right. So let's go to the accounting entries. So accounting entry is debit, P&L, that's impairment loss, and credits, PPE, with the impairment loss recognized on the asset, right? So in the case of a revalued asset, what you do is you debit revaluation surplus, which is your OCI this time, with the impairment loss up to the value of revaluation surplus earlier recognized. Then you credit PPE. Sorry, you debit P&L in case there's still balance with the balance of the impairment loss. And then you credit PPE with the total impairment loss on the assets. Does it make sense? Does it make sense, please?
So this last one, debit, and credit, right?
Yes.
Okay. Okay.
All right. So now another thing we want to talk about is reversal of impairment loss. So again, there are cases where you may want to revalue your asset, right? There are cases where you may want to revalue your assets. I mean, I said revalue. There are cases where the indicators of impairment are no longer present, right? Where the impairment issues are no longer present. Say, for instance, if it is external indicators and those indicators are no longer present, right? And then you want to reverse the impairment. You want to reverse the impairment loss earlier recognized. So in that case, it's just in the case of like you always do that evaluation where you always continue to test for evaluation of the asset. The same way, once an asset is impaired, you can always continue to test, right? You can always continue to test and see whether the indicators are still present. So in case you want to reverse your impairment loss, what you do is you debit PPE, right, with the reversal of impairment loss, right? Credit P&L with the reversal of impairment loss, right? But the amount should be reversed. Are you with me? Must not exceed the initial impairment loss earlier recognized. That's the idea there. And the same thing here, if you want to do the other way around, if it was in the case of revalued assets, you debit PPE with the reversal of impairment loss. Then you credit revaluation surplus with the impairment loss that was passed there, right? Don't forget, evaluation surplus here is your OCI. I have my reason for saying that is your OCI, and that's the difference between the first and the second. Are we together, please?
Yes, sir.
Hello, are we together?
Yes, sir. Yes, sir. We are with you.
Payment loss. Up to the value of earlier recognized, then credit your P&L in case there's still a balance. Are we together, please? So that's that about reversal of impairment loss. So in the next class, we'll be looking at some illustrations around reversal of this impairment loss. I mean, about impairment loss, and then we'll be looking at cash generating unit. And after that, we'll be moving straight to assets held for sale and discontinued operation IFRS 5. All right, so it's time for questions. In case you have any question, please feel free to ask. Any question for me?
So what would result to a reversal?
So say for instance, the things that you thought led to the impairment loss are no longer in place. So say for instance, there was volatility and then now it is now stable, but the reversal is always on the back of what's the name now? On the back of improvement in the indicators of impairment, and it's typically your external indicators that are improving, not mostly the internal indicator. Does it make sense?
Yes, sir. Thank you.
You're welcome. Yeah. So what are other questions before we call it a night here?
I put a question.
What do you say?
I just want you to explain briefly the difference between impairment and depreciation of an asset.
So impairment loss is reduction, but we don't expect it to happen. If I would use a layman term, right? Why depreciation is what we expect would be the reduction in the value of assets, right? So in other words, we are saying that for depreciation, we know it will happen. We know the assets should reduce, and it should reduce systematically over what we assume to be the useful life of the asset, right? While for impairment is a sudden reduction in the value of assets. Nobody prays for an accident, right? But if there's an accident in on a car, for instance, then what has happened is impairment loss. Do you get?
Okay, yes.
All right.
Hello, sir.
Yes, sir.
Please, I want to find out this impairment loss to some kind of reasoning. Somebody will be expecting that there should be an impairment. So a word like impairment gain. Is it grammatically wrong having an impairment gain or practically wrong?
The standard does not emphasize impairment gain, but there's nothing like impairment gain. But again, there is possibility of increasing the value of the asset. So when the value
Which is
of an
called
asset,
revalued.
Exactly, it's fair value gain or revaluation.
Okay. Okay. Thank you, sir.
Right.
Hello, sir. Hello, sir.
Yeah.
Well done,
I'm
sir.
with you.
Yes, sir.
Thank
Please,
you.
I need more explanation on reversals of impairment loss, sir.
So again, reversal of impairment loss will occur when there is an improvement, right, in the indicators of impairment, right? That's when the things you thought are adversely affecting the assets are no longer going to affect the asset adversely. That's when you say there's reversal of impairment loss. Does it make sense? Those
Yes, sir.
things
Thank you,
that
sir.
we felt is affecting the assets adversely no longer persist. So the standard says if you are sure that does not persist, then you can actually pass your entry again. Just rewrite what you did the other time. That's what it means basically.
Okay, sir. Thank you, sir.
All right.
Sir, please, can we get this note after the class?
I've
Please?
sent it to group 1 already.
Okay,
So
all right. Thank you very much.
you get it.
Thank you, sir.
You're welcome.
Please help us send it to that group, please. Please help us send it to that group.
Yes, I'm sending to that group. That's what it means. Send to that group. Do you have any other question before we move on? Before we call it a night? Yeah.
It's not yet on group 1, no, sir.
Okay, don't worry. It's there. Check it again.
Hello, sir. I have a question.
Are you using 2G?
You are using the same data. I'm not using 2G.
Hello, sir.
All right. Yeah, please go ahead with your question.
Yes. In terms of IAS 16, property, plant, and equipment, the example you gave as regards the employees who the company rented the property to the employees at
Yes.
market price.
Yes.
And you said that the standard is IAS 16, not IAS 40.
Yes.
Is there a situation where it can be IAS 40, renting out your property to your employees?
If it does not, so it is going to be, or I don't see any reason why it should fall under IAS 40, except you are treating your employees at arm's length. But don't forget that for the question we treated, the major reason why he's renting to them is because of proximity to the workplace. He wants them to resume early. So invariably, technically, still not owner occupied. Do you understand?
Okay. The question was a bit tricky because when I saw the markets at market price.
Yeah, you would assume it's at arm's length, right? But again, the examiner made a clause that the major reason why he's even giving them the apartment is because of proximity to the workplace.
So it's just like the extension of the organization then.
Yeah, exactly.
Okay. But if the examiner have said that maybe it was rented out to maybe another organization now, then that would be treated under IAS 40.
That's IAS 40. That's investment property. So it's not built for employees. Anybody can come, even including the employees, right? So it's not built typically, but it's for rental income. Then it falls under IAS 40.
Sir, I also want to ask. Somebody asked of the impairment gain. I would say there's nothing like impairment gain. So meaning that by the time we conduct impairment test and there is no impairment, there's no way of saying there's a gain. I think it's just for us to comment that there is no